Ladies and gentlemen, the forum is about to start. Please take your seats.
Just to remind you, I'm the other Simon, Simon Cox, Emerging Markets Editor for The Economist. And for the next 2 sessions, we're going to discuss that term, emerging markets. It's not actually that old. It was invented in 1981 by a person called Antoine van Agtmael, a Dutch economist who was then working for the International Finance Corporation, a division of the World Bank. And he had done some work on 10 relatively unknown stock markets, and he saw that the returns were actually pretty good, but it was very difficult for people to invest in a spectrum of these markets and very risky to invest in any single one. So he came up with the idea of an equity fund that would encompass 10 of these markets, and he called it the Third World Equity Fund. And he presented it at a gathering a bit like this in New York. And one of the members of the audience actually told him, love the idea, hate the name. And the name, Third World, to this investor, had all sorts of bad associations. It called to mind flimsy polyester, cheap toys, Soviet-style tractors, rampant corruption, flooded paddy fields. And so in order to distance these economies from those associations, Antoine came up with this term, emerging markets, which he thought was a much more optimistic, progressive, uplifting term. And of course, it's been a huge success. We're still using the term now. In fact, I am emerging markets editor for The Economist, so I owe Antoine my job title, if not my job. We're going to be discussing emerging markets, both leaders and laggards, in the next session. But before I start that, and before I start asking some questions of my distinguished panelists, I'd like to ask you all a couple of questions. We have this live polling app you've probably been hearing about. In order to download it, you have to go to the App Store on your phone, to Attendee Hub, and then once you've found Attendee Hub, look for Global Financial Forum. Once you're there, you should see a live polling screen where you can answer a couple of questions that I'd like to pose now. So if we could have the 2 polling questions for this session, please. I was looking left. So the first polling question, is the term emerging markets too broad? Yes or no? I should add, you've got the whole of the session to answer this question, so if you want to wait to hear what our panelists say, you're quite welcome to. Given that my title is Emerging Markets Editor, I think you could interpret this first question as, do I have too much work to do? Yes or no? The second question, which region has the most growth potential? And there you're given a choice between Africa, Latin America, Asia, Central Asia, or the Gulf. So to discuss some of these opportunities, some of the laggards and leaders, I have 2 panelists, both focusing on different parts of the emerging world. And I'd like to invite them to join me on the stage right now. Muyiwa Oni, who is Regional Head Equities Research for West Africa of Stanbic IBTC Bank. Please come and join me. And Houssam Nasrawin, who's CEO of GDC, Gulf Development Company Partners, a venture capital firm based in Abu Dhabi. Thank you both for joining me. Thanks, Houssam. Muyiwa, perhaps if I could start with you. Your focus is very much on West Africa, as I understand it. And within that region, what do you look for when trying to decide where to invest and where the leading emerging markets might emerge from?
I'd say investing in Africa, and I'd say in particular West Africa. So through my experience over the last 10 years, I've been looking at the market. For me, I think governance stand out as what's critical for not just countries, but also businesses as well. So if you look at companies that has outperformed over the last 10 years, the people, so the CEO, how he sets out strategy, clearly is a driver for how performance has been. So if I highlight a few companies in the banking sector in Nigeria in particular, for example, Guarantee Trust Bank has outperformed all the Nigerian banks over the last 10 years with market cap growing in multiples and delivering strong ROE, delivering strong cost-to-income ratio as well, driven by how management sets out strategy. And then if we look at countries, also governance, policy helps, and that I would argue stands out materially.
So it's obviously great if you can find a company with good corporate governance in a country with good political governance, but we don't always get that combination.
Yeah, it's far more complex.
It is more complex. But if you had to choose between bad corporate governance and bad political governance, which is more damaging to your investments?
That's a very difficult question, I'd argue. But I would say ultimately, bad political governance, I would say, it's far more damaging. So if you look at a country like Côte d'Ivoire, for example, in 2011, there was a civil war post political, there was an election and a civil war broke out, and that had negative impact on the economy. But since then, there's been far more stability, and the country actually stands out now as the far better performing economy in West Africa. And it's I would say, practically driven more by stable political policy, and that is translating into better agricultural production. So cocoa production has been much more stronger. We're also seeing far stable monetary policy as well. So inflation, interestingly, it's now down to about 3%. And
3%?
Yeah, 3%. And it's also, in terms of our outlook as well, is an economy where we see economic growth, real GDP growth, growing an average of about 7%, I'd argue, over the next 4 years, even though there's still concerns around political stability as well, because the current president's tenure will be up in 2020, and there's questions around what happens outside that, because I would say one challenge we've seen in Africa, and I would say in West Africa in particular as well, is that during political cycles, you tend to see a material slowdown in business because there's little drive in policy reforms. And so for countries that have a 4-year political cycle, 1 year is lost to elections.
Right. So, I mean, this actually raises a very interesting question, which is, what is the best time to get into some of these countries? And perhaps after a period of political tumult, it's perhaps not a bad time to look for high investment returns. Is that part of the story with Côte d'Ivoire?
Yes, I'd argue that's clearly been one key driver. And even though the reality as well is that with politics is extremely risky, I think particularly when you think about what's happening in Kenya right now, where there's been disagreements. And in terms of timing as well, it's difficult, or it makes sense to wade through the issues. But I also argue that if you're in the market already, sometimes it's also an opportunity to increase your investment. So if you use Nigeria as an example, in 2015, there was an elections, and at some point, there were more uncertainty because there was a delay in the election date as well. It was pushed forward. And because of that, there was a material sell down in the stock market. And that was an opportunity for investors to pick particularly good value companies. So I'd argue that in terms of timing, most of the time it makes sense to wait through to see things settle before coming in.
And you mentioned that inflation is only 3%, which does strike me as remarkably low for a frontier economy. To what extent does that reflect the currency arrangements there, the peg to the euro through the CFA franc?
Yeah, I'd argue that seems to play some strong impact as well. And another country that seems to be showing good signs of growth, Senegal, also does have very low inflation. It's around 2%. Senegal is an economy that has grown by an average GDP of 4.2% over the last 5 years, and we expect GDP growth of close to 7% for the next 4. And there as well, you see better and strong political reforms. Interestingly, unlike other African countries, parliament has voted to reduce the tenure of presidents to 5 years from 7, which I would argue that rarely happens in African economies. There's also been strong reforms in sectors like agriculture as well, and far more diversification of the economy, so more of a combination of mineral resources and also of agriculture, more agro processing. And so I would argue that for that region, the currency does play a part, but a combination of good regulatory and fiscal reforms also does help.
So in Senegal, they used to have 7-year presidential terms, and now they've reduced it to 5 years, which is great for curbing the power of the executive. But does that mean that you get these political cycles more often now?
Yeah, I would say, unfortunately, that's also that risk. That's a risk that comes and shows up as well. And I would say for Africa, particularly sub-Saharan Africa, we have regions where there have been migrations from dictatorships to a bit more stable democracies. So Nigeria is an example. Ghana as well is an example as well. I think for those economies that trying to balance with having two strong parties. Because the challenge you have with those environments is that because with politics, what you think about more is its popularity, and sometimes the most popular decisions are not necessarily the most expedient or the best decisions. And so you have situations where government delays critical reforms because of popularity.
Right. So it seems like the PEG has served Côte d'Ivoire, perhaps also Senegal, quite well. Turning to Nigeria, that's also an economy where the exchange rate is heavily managed. How has that served their prospects?
So for Nigeria, it's been far more negative, I would argue. And for the country, I think it's also more because there was a shift in FX policy as well. So before 2014, the oil price was relatively strong, and that helped to support reserves. But unfortunately, at the time as well, government wasn't efficient with revenues. And so when oil prices crashed, and unfortunately as well, there was a combination of reduced production because of disruptions in the oil-producing region. That had a negative impact on flows and on reserves. And so the central bank at the time decided to restrict the FX market, which had a far more negative impact on the economy. So even though the economy is diversified from oil, so even though oil accounts for 90% of FX flows into the economy, oil accounts for only about 10% of the economy, but provides the FX to drive other sectors like trade and manufacturing. So restriction in that market had a far more negative impact on the economy and push the economy into a recession. But I'd say thankfully there's been a shift to a far more friendly FX system, and so we're still hoping for more improvement in that region.
Do you think there are further reforms required to the FX regime, or you think they've reached a good modus vivendi?
I'd argue that there's still some more room to go, and I think the reasons why is because we still have multiple exchange rates. So even though the margins are far more thinner now than where we're coming from, but because there's still different exchange rates, and if you're a bank, for example, even though you do your business activities at a far more flexible exchange rate, and the window is called the importers and investors and exporters window, but you still report your balance sheet at your official rate. And then that rate as well is what prices of petrol is priced at. So there's clearly far more room, but I'd argue that it's become a political question as well, because that's the rate used for petrol subsidies and electricity tariffs, which is still regulated by government. And right. And because currently we're moving closer to elections, as Nigeria, elections will be February 2019. And so it's difficult to see that government will be far more willing to make a change in that policy, or to be far more relaxed with the policy.
So you've got this very interesting interaction between the commodity cycle and the political cycle in this part of the world. Houssam, you've been waiting very patiently. I asked this rather mischievous question: if you had to choose between political governance and corporate governance, a badly run company in a well-run country, or a well-run company in a badly run country, which would be the best investment? I don't know if you have strong feelings on that.
I think first of all, in the Middle East, the situation is very different than in other parts of the world. Much more than maybe the political aspect, the government plays a bigger role than in Africa or in other countries. That's why I believe it's very difficult to answer to this question. There is a mix. The political aspect is very important. The government has a role to play in order to encourage the business initiatives, in order to create a good environment for international investors, for the domestic market. And then this is the role of the private sector to generate business, to do it in a proper way. So I think in the Middle East, we have first to count on the government in order to create the good environment for us, and then the private sector has a role to play. So personally, if I have to answer to your question, I prefer to be in a good environment, supported by the government. And at GDC Partners, in our company, we invest and we advise company, and we always focus on countries where you have a strong political stability. I think in the Middle East, this is the main criteria for companies. Because even if you don't run your company very well, you can still learn, you can still improve, you can still find investor, you can still change the management. But if the political environment is not good enough, it's not possible for you to succeed unless if you have some good network or something like this. But it's not possible for most of the people to succeed in a bad environment. So that's why I believe today in the Middle East, we have to focus much more on political stability, on the role of government to offer stability, of course, to offer transparency, to offer access to financing, to offer good governance. And so this is the main factor for me in order to succeed in this region.
So let's try and disaggregate if we can.
Yeah, sure.
I know your company is very active in obviously the UAE here, Saudi Arabia, Bahrain, also Jordan, Morocco, Egypt, I believe. How do those 6 countries compare in ease of doing business and how well the government is acquitting itself?
Of course, the UAE is the country where it is the easiest to do business. A lot has been done, driven by the leaders of the country, Sheikh Mohammed bin Rashid and Sheikh Khalifa and Sheikh Zayed since the inception of the country. So, of course, the UAE is a different story. Now, regarding the other countries, we invested a lot in Jordan and in Morocco because we believe in the political stability of those countries. And I come back to what you asked me at the beginning. Our criteria is to invest on countries where you have a strong stability. We are in the Middle East. It's a very young region. The UAE is 47 years old. Jordan is, I think, 71 years old. Egypt is less than 100 years old. So you cannot think on the short term. You have to think on the long term in this region. It's not possible to say this country is performing well and this one is not performing well. You have to think on the long term. And our main criteria is really to understand the stability of the country and the will of the government to offer good business environment to people. If I invest in a country and I'm not sure tomorrow I will find my investment back, if I think the government will take my money, if I think there is strong corruption, it's not possible to invest. So that's why in those countries you mentioned, we are very active, either for advisory or for investment, because we believe in the political system of those countries. If I have to rank them, as I said, UAE is, of course, number 1. Then we believe in Jordan because we established a company in Jordan to target Iraq and Syria, the reconstruction of those countries. It's a little bit early, but we believe Jordan will be the gateway for Iraq and Syria. Egypt is, of course, a booming country. There's a huge potential there. A lot of political reform have been done, so we believe in this country. And Morocco, we were very impressed by the pro-business environment in this country. So also we invested in agriculture in this country, and for the moment it's performing very well. It was done last year only, but we hope to have a very good return on investment on it.
That's interesting. I mean, you mentioned that you see Jordan as a gateway
yes.
To Iraq and Syria. And you also said that it's a bit early, but how early? And how early should people be thinking about those big potential opportunities that also carry a lot of risk?
If you if you go to Syria and Iraq or to all those, we cannot say emerging country because they are not emerging country. They are still, like there is everything to do there. So if you go when everybody's there, it's too late. It's like coming to Dubai now. You make the big business maybe 10 or 20 years ago. Now it's a developed country. So I think Syria and Iraq, for the moment, it's impossible to know what will be the political situation, if there will be stability or not. We saw recently that there was a conflict between Kurdistan and the government of Iraq. So it's very early to know what will be the situation. However, we believe that European companies, international companies, have a big role to play in the reconstruction of those countries. And our role is to advise SMEs to help them to go there. So we create partnership between public and private entities. We work with the public entities in order to protect the investment of those people, even if it's too early, as you said. So for the moment, we don't know what will be the outcome, but we try to work with entities to protect the investors, to protect their assets. And at the same time, we work with investment funds in order to support those companies to invest in the country. We cannot think today that European company, for example, will invest in Syria and Iraq, their own money. I don't think it will be the case in the coming years because it's too risky, because they don't understand how the country will change in the coming years. So our role is to help those companies to secure the funds, to bring their expertise, and we bring them the protection with the government and the local entities.
Explain protection a little bit more.
Protection is a very vague as term for the moment, as I told you. We work with public entities, with chambers, with the government, with local companies, in order to say to people, you invest in this country, we help you to secure your assets, that not in 2, 3, 4, 5 years, government or another company will come and take your assets. So I think it's very important to have the same system as in Dubai, the local partner. A lot of people maybe don't understand the crucial role of local partner in the UAE, but he's normally here to protect you, to protect your assets, and to make sure that you will generate business. So it's exactly the same idea we are trying to build with Iraq and Syria. We make partnership with public entities, as I said, but also with local private companies. And those local companies, they, for example, create GV, partnership, whatever. They are here to provide you business, but also to protect your assets, making sure that they have the right connection with the government and with the other entities in order to generate good business for you and make sure you will get your money back.
You mentioned Egypt as one of the promising areas to invest in, booming economy right now. What accounts for that turnaround in its prospects?
I didn't understand exactly.
How do you explain the secrets of its improved economic prospects?
Egypt, I think we have to see the potential of the country on the long term. For the moment, thanks to the government of Sisi and the new economic reform, the will to attract FDIs, the country is performing quite good. First, you have to take into account that it's one of the largest countries in the region, #1 in the Arab world. So demographic aspects plays a huge role. Then the government has a will to encourage FDIs, to attract investors. We remember the conference of Sharm el-Sheikh, I think it was 3-4 years ago. There was a reform in order to make the more transparency, in order to encourage people to do business internally and also from outside the country. So I think there is a strong will from the government. And I come back to what I said. The government in the GCC countries, in the MENA region, has a big role to play to encourage foreign investors to come. And this is, I think, today the will of the government of Egypt.
Muyiwa, if I could bring you back in, do you think that Nigeria perhaps could learn something from the way Egypt has handled its currency and its reform program?
Yes, I would argue that there's clearly room for improvement with the way Nigeria has handled the FX situation. And I think particularly fixed income investors that invest in Africa all keep on pointing to the level of improved transparency that seems to have happened in Egypt versus Nigeria. So even though with Nigeria there's there was an introduction of a far more flexible exchange market, but still there's still multiple exchange rates. But with Egypt, that doesn't seem to be the case. So even though there's still the argument that it's still kind of a managed FX market as well, but I would argue that with Nigeria, there's still room to reduce the number of exchange rates. So currently, we still have about 3 broad exchange rates, which can easily move to at least 1 or at least 2, if not 1. And I think for government as well, for the Nigerian government, their argument has always been that they've always been 2 exchange rates. And so there's this central bank's exchange rate, which the interbank market trades off from. And so their argument is that there's clearly been level of improvement. So if you think about where the market was last year, where there were close to 10 or 11 exchange rates, there's clearly been an improvement, reducing that to a bulk of 3. So it's strong progress. And we saw that in the level of interest and increase in demand of Nigerian equities as well, and Nigerian securities in general, where over the last 3 months there's been about $10 billion of liquidity in the FX market since the market was introduced.
And more broadly, do you think there are lessons that could perhaps be transferred between the 2 regions? I mean, I think, for example, about the free trade zone here, which has obviously been a great success. I don't know, Houssam, if you could explain why that worked. And perhaps, Muyiwa, if you could talk about free trade zones in sub-Saharan Africa that may have replicated that success or not. Houssam.
Free zones, it's an excellent idea because, you know, the mentality of foreign investor and people who want to set up a company in UAE or in other part of the Middle East, they are always scared. They are always scared because they don't know the environment, they don't know the country, they don't know the regulation, they don't know the local partner. They are always scared that he doesn't work good or he steals your money. So the free zone is an excellent idea to protect the investor, to offer them a good legal framework. So it's something that works very good, especially in the UAE. And one of the reasons of the success of the UAE today is the free zone. It's obvious. Now, just a small remark. Some of the free zone company don't work or don't perform well for one very simple reason, is that when you come from another culture and you try to set up a business in the UAE or in the Middle East and you don't understand the culture of the country, it's not because your idea works, for example, in France or in Germany or in Nigeria, that it's going to perform good in the UAE. You have to understand the culture of the country in order to do good business in the country. And this is something most of the people don't understand. We established 200 companies in the UAE, free zone companies. Those that we don't support enough, like not most of them, but at least half of them don't perform as they were performing in their country because they don't take into account this cultural aspect of the business. And this is just to finish about this. This is where the role of the local partner is important. The local partner is here to support you if he does his job good, of course. He's here to support you, to give you access to the decision maker, private and public. When you are in a free zone, most of the time you don't have a local partner. So this is where you have to think also, should I establish my company in free zone? Am I strong enough to have the right connections? Or should I work in the local market with a local partner? And I work mainly with Europe for foreign companies. Most of European companies, they don't understand the role of the local partner, and they prefer to go free zone by themselves because they are successful in their country, and they don't succeed in the UAE if they don't understand this cultural aspect.
So that probably reflects an overconfidence in their own abilities, but it might also reflect a certain concern about local partners.
Yes.
Are there principles or rules that foreign investors should apply to choosing a local partner? How can you tell who's a good local partner and who's not?
First, it's not only about the UAE, but about the region. I think the UAE is once again a different case, but I think there's a huge problem of communication in the Middle East. Most of the countries in the Middle East, because the idea of local partner is not only for the UAE, most of the MENA countries use the local partner, but there's a huge problem of communication. we work a lot with Europe, with US, with other parts of the world, and most of the people don't know how to open a business in the MENA region. They don't know how to start. They don't know how to choose the local partner. They don't understand the role of the local partner. You know, in the news in Europe, they always talk about, oh, this guy, he took your money, he closed your company, and people are scared. So I think, first of all, MENA countries have to insist on the communication, on how to do business in their country. This is very important. Then regarding the local partner, you have to do your due diligence. That's as simple as it is. You have the embassy, you have the Chamber of Commerce, you have the lot of authorities in the country to check about who you are working with. It's not because he say, oh, I know everyone in the country, I can help you, I can do this, that. Everybody say this. At the end of the day, the local partner is not active. And it's your fault if it happens, because you have to do your due diligence. So I believe you have to do your due diligence, check, meet him, not 1 or 2 meetings. Go meet him, see his company, ask about the company he already sponsors. Do your due diligence, and I'm sure it's going to work good.
Maybe you need a local partner to help you choose a local partner.
We are here for that.
How much of that applies also to the countries you study?
I would say, so to my earlier point, people matter a lot, and the credibility of people clearly differentiates how successful businesses are. And so with partnerships as well, which sometimes you might argue that it's difficult to select, but I would argue that with Africa, you have to take your time. You can't rush into making decisions, because with time dealing with people, the true character will show. So that will be my own recommendation and view, and based on experiences that I've had.
That sounds very sensible. Do we have any questions for our panelists from the audience? We have a few minutes left, so if anyone would like to ask about any of the economies we've discussed, or reconstruction in Iraq and Syria. There's a woman near the back, if you could just wait for the microphone to reach you.
Hi, my name is Harriet Smith. I work for a company called Berry, Palmer & Lyle Limited, based here in the DIFC, but headquartered out of London. I was interested to hear the panelists discuss countries such as Iraq, Egypt, Morocco, for example. And one of the comments was that it's unlikely that people would invest in these countries at the moment when they might be concerned about the host government seizing their investment in some form. And I just wondered whether you had considered that there is a whole private insurance market out there that covers exactly that type of risk, from government expropriation, confiscation, nationalization, deprivation. So there are ways of mitigating the risk, and I wondered whether you guys ever used it.
I'm sure it's priced very attractively.
Very
what do you think
competitively,
actually. Can you insure against these sorts of risks? Should you?
As I said, if you think about the Middle East on the short term, like what will happen in 2018, 2019, honestly, I don't think you should invest in the MENA region. If you target short-term return, forget the MENA region. There will always be problems of political problems, crisis, wars, refugees problem. Even the government can nationalize the companies, etc. So yes, you are totally right. I think today, if you target short-term return, don't invest in the MENA region. But you have to focus more on the long term, on the potential of the countries, and see your return in maybe 5, 6, 7, 10 years. This is my first point. The second point is also understanding the will of the government to attract foreign investors. A lot of countries, especially in the GCC, diversified their investments, diversified the sectors where they focus the business. And you have to understand, is there a will from the leader of the country? Is there a vision from the leader of the country to attract investors or not? If you think it's still not very stable, forget those countries. If you see that, yes, they are here to protect the investors, you can think about it. Even if it's not perfect for the moment, I think on the short, like middle term or long term, the situation will be better. So this is my answer today. Don't focus on short term and on the current problems.
We only have 1 minute left, so I may have a look at the results of our opinion poll, which I'm awaiting with great suspense. I made the mistake earlier of looking at my ugly face in the left when I could have been looking at the right. Can we see the results? So this is the question: is the term emerging markets too broad? Overwhelmingly, yes. My job title is inchoate, and I have far too much to do. And then the second question: which region offers the best growth prospects? Can we see the results for that, please? It's a neck-and-neck tie between Africa and Asia. How exciting. I wonder if there's time left for the last person to vote and break this tie. But that's rather nice. Okay, well, that's a good note on which to end. Thank you very much to both of my panelists, and thank you to the audience for taking part. Thank you.
Thank you very much.
Thank you. Thank you for the best. And I'm going to stay on stage for the next session, which gives me great pleasure to invite Arif Naqvi to join me, who is Chief Executive Officer of the Abraj Group, which is one of the leading private equity firms in the world, and certainly in this region. And we're going to be discussing a similar topic: